Hey everyone, it's Charlene Lee. Thank you for joining today. And today I'm going to be talking about the last part of my series on stakeholder capitalism about how to create win win situations and initiatives. Now, this is a big problem because in stakeholder capitalism, the idea is that when you have different stakeholders, so of course you have your shareholders, the people who are the owners of the company and want to get returns on the investment they've made. Then you also have people like your employees, your customers, your suppliers and partners. And of course, there's your communities and Mother Nature, the planet Earth. And so these are all different stakeholders. And the question and the problem with stakeholder capitalism is how do you balance all of these interests, all of these competing interests together? And the overwhelming sense is that, well, in order to meet the needs and to create value for all of these other stakeholders, shareholders have to give up value. And so there's been this long this battle to say, how do you actually make this happen? Because we all agree it's right to create value for employees, pay them more, pay them a living wage, increase the minimum wage, for example, above the poverty line in some places. But when you do that, you increase your costs, you decrease your profits, and you're hurting your shareholders. So how do you make this a win-win? So what I want to talk about today is how to do this. And in particular, how do you shift from operating in this world of scarcity to a world of abundance? Because I fundamentally believe that if you are able to increase value across all of your stakeholders, you will increase value for all of them and also increase the value of the company and therefore it really serve the needs of your shareholders in the end. So, just to begin today, what I'd love to do is for you to share where you are coming from today. And also, please ask questions as we go along. If you've been tuning into these live streams or have seen some of my writing on LinkedIn, then what you'll see is, again, a series of conversations around what is stakeholder capitalism? How do we define it? How do we measure it? Is what I talked about last week. And today we'll talk about strategies of actually how to make it happen. So, we have one of the things that we can do is think about, first of all, what is the issue here? And I think one of the biggest issues is how do you balance and maximize the needs of each of these stakeholders? And one of the biggest mistakes is that we're looking at each of them individually instead of the reality, which is they are all parts of a large ecosystem. And when you're talking about ecosystems or systems, then they're interlinked, they're connected to each other. There's an interlock that it's really hard to untie. And instead of trying to maximize the value for individual stakeholders, we need to be thinking about maximizing the system value. So it requires systems thinking. And it's more than just win-win. Let's pick shareholders and how to increase their value while increasing the value of employees. Because once you can do that initially, but then there were other implications across the entire system that you have to think about. So the way I think about this is that one of the issues for something that we know really well, one of the reasons why shareholder capitalism has worked so well, is that it really relies on the efficient allocation of resources to say, what are we going to spend our limited time, money, people, dollars, capital on in order to return a value to the shareholders. And when it works really, really well. Companies know what their customers and consumers want. Management is in sync with their shareholders. The government ensures that there's plenty of competition, free flow of information. And the reality is then businesses are able to take a long term, invest in shareholders, invest in stakeholders because they see that the value created by stakeholders result in a long-term value of the company. And so in many ways, a shareholder capitalism, if it's engineered in the right way, works because it's looking at profit maximization over the long term. But the problem is we don't necessarily do this the right way. So we have the biggest issue is that there are too many trade-offs, too many different systems to be able to stakeholders to be able to understand and tease out all the different implications. And so stakeholder capitalism sounds great. You want to create the overall value of the system, but how on earth do you do it? because we can't look at these complex systems. We also know that some of these win-wins are not really win-wins. For example, we have carbon offsets. Uh, if you create emissions, then you can buy carbon offsets, but it's not really addressing the core problem, which is you're creating a lot of emissions. And this shared value again idea isn't necessarily working. I'll give a more tangible example. If your team has been working really hard, going at it hard, really working on a project, you bring in a pizza lunch to feed everyone, it definitely boosts the morale of everybody, but it doesn't address the longer term issue that your team is under a lot of stress and fatigue. And unless you take that pressure off of them, they're all going to burn out and leave. The pizza lunch isn't going to sustain them. So that's how I kind of feel about some of the ways we think about stakeholder value right now. We're looking for these individual win-wins, but it's not really a win-win. It's not creating value. You're just kind of covering things over. So I have 4 approaches that I want to share today. The first one is thinking about stakeholder capitalism not as trying to divide up a fixed pie, but increasing the overall pie. And the idea is that as you are creating value for your stakeholders, you're also creating value for shareholders. And the rising tide lifts all boats. So you're moving from a point of scarcity to a point of abundance. And one of the examples of this is if you look at I think it's the Forbes 100 best companies to work for, they have a list of these people. They beat their peers in stock returns on average between 2.3 and 3.8% per year over that past 28 years. And the idea is that investing in your workers isn't necessarily a dig on your profits. By investing in them, it enhances your profits over the long term. And so it requires, again, that shift in time frame, which is why the metrics really matter. I do believe that you are what you measure. So what's really important to you is about keeping your costs as low as possible. And so getting the lowest cost of labor, but are you getting the best labor possible? So retention issues, are you paying people a fair wage? There's all these examples of ways to think about what's really important and what really truly drives long-term profits. So one is to think about how do you increase the pie by making investments in the short term for the long term. So just want to say hello to a few people who've joined. So I have Key, I think, joining from Amsterdam in Netherlands. Love Amsterdam. Used to live there early in my career. So great to see you there. Brian is waiting in the airport in Las Vegas for some new flights. Hopefully you get to your destination well. And Gina coming in from icy Austin. I'm so sorry. The weather, this crazy weather in Austin. So hello, everyone. So please, again, share where you're coming from. And again, ask any questions that you may have. So the first approach to creating this win-win approach to stakeholder capitalism is to think about, first of all, increasing the pie. So you're not trying to just take away from existing shareholders and stakeholders. You're not having to make those trade-offs. You're actually creating these win-wins for the long term. The second thing is to think about how you actually generate profits. Now, I shared before that shareholder capitalism, traditional capitalism, says sell more, increase your prices, keep your costs low, and then you can increase your profits either again by growing the pie or increasing your margin. And one of the things that stakeholder capitalism has said, maybe you turn this on its head, maybe the way that you create profits is only if you are creating value for society. And so the idea that this is that serving your community or the environment doesn't come from just making more charitable donations or from offering low prices to your consumers. It's actually coming from a place of committing to better business practices. Again, innovation, excellence. It's not just creating more margin or just creating your share of the market. It's also doing things in an excellent way. And you're creating value then for society by creating better products. And then you're also creating that profit by just increasing the value to your ecosystem. So the idea is that you actively do good to benefit from it. And it's more than just don't do any harm and therefore make profits. It's actually actively saying, because we do good, because we operate in a really thoughtful, conscious way, in an intentional way, we're going to make better quality profits overall. And I'll give the example of Chobani, the yogurt company. There's nothing inherently socially redeeming about a yogurt company. They're not saving the world by creating better drugs or having a public service, and they're not transitioning from carbon-based oil, for example, energy to renewable energy. They're a yogurt company, but yet from the very beginning, the CEO, as the founder, had agreements with all the different stakeholders, with consumers about the quality of the products that was environmentally well produced, agreements with their suppliers, agreements and compacts with their employees. In fact, in 2016, I believe he created a distributed 10% of his personal stock holdings back to employees. And this really became an issue when they decided to scale up, become $1 billion company with a new plant in Idaho. And as they were scaling and creating new products, they ran into mold contamination, products that were not at the quality levels. The lines were having problems with production. And he leaned back into his suppliers, leaned into the relationship with customers, and also called on to his employees to pull together, and also the reputation with his investors on Wall Street and private equity investors in particular, to really come together to create this value. Got through that tough point, and then again focused on doing the right thing right from the very beginning to generate the profits. So I think this mindset that you only create profits, the profits only come through creating value for society, is a different way of thinking of orienting the entire company. Of course, you have to run a good company as a result and have that excellence and innovation, but it's a different way of thinking about things. I just want to say hello to Kimberly, who's actually joining from sunny South Florida. So thank you very much for joining, Kimberly, too, as well. The third area is about how leaders are showing up. And this is idea of being responsible, of establishing trust too as well. It's one of those win-wins that doesn't necessarily have a tangible approach to thinking about the different stakeholders. But I'll just give you an idea that as we are moving into this world of stakeholder capitalism, of just being more responsible businesses, leaders are having to show up and be also vocally responsible. They need to be thinking about how to do well and do good, because it's no longer acceptable, frankly, for a CEO to say, I am just here to produce profits for my shareholders. And that's the most important thing. And forget everybody else. This is what we're trying to do as a company. I don't think any company, any board, any CEO, any member of the C-suite can actually do that. So it's much more about how do we do the right thing and do well and do good. And it's actually been changing. So one of the things that we look at oftentimes is the Edelman Trust Barometer put up by the PR firm Edelman. And one of the things they've showed now is that in terms of who people trust, my employer, my company, is now trusted more by the public in most countries than government leaders, non-government organizations, and media leaders. Now, you could say that may be because the government leaders are just falling in terms of our trust of them. But overall, I think employers are doing a better job of connecting with employees, understanding their needs, meeting their needs, being responsible members of our communities, being stewards of our environment and our planet. And this change in the values, but more importantly, in the actions that those values are driving, is increasing that level of trust across the board. Now, there are some significant challenges to this. And that is, for example, what happens when you are actively, as a company, lobbying the government in Washington and state capitals to lower taxes? So are you paying your fair share of taxes to, again, support the community? Are you looking at, as a leader in the organization, at the pay of your highest paid executives and how different that is from the people who are at the lowest rungs of the organization? What is that difference? In some cases, it's hundreds, if not thousands of dollars times the difference, that inequity that's built into the company. And if you look at this past year, a year ago, when Ukraine was invaded by Russia, so many companies were willing to pull out of Russia because of just the human rights violation. It's just the wrong thing. But in most cases, companies really didn't have a lot of crucial business in Russia. I think the issues going on with China right now are going to cause even bigger issues because a lot of companies have big stakes in the area, in the country, and in the region. China's a much bigger player, member of the World Trade Organization, et cetera. So where do these values lie? When do we draw the line? And so there are some big issues looming on the horizon. Do we pay a fair and equitable wage, like Bank of America has been doing, increasing that wage to where people can actually survive and live? So the question here becomes, and I think Jay has a great point here about greenwashing. Thank you, Jay. I love when you chime in with these counterpoints. The one of the key questions is, how do you actually keep this from being greenwashing? And this is where that accountability comes into play. I think people are very aware now. You can't just sign a document like the 2019 Business Roundtable statement about what the purpose of an organization is and not actively say what you are trying to do about it. So the third approach actually talks about this, which is a very much an investor approach to thinking about these things. And this applies more towards public companies, but it also can work for individual companies, small businesses, even ownership shares. And that is, the reality is investors, these shareholders, also care about doing good. We see this in this huge rise, especially since the pandemic, of people doing ESG investing or conscious investing, impact investing. It has many different names. And the idea is that people want to invest in companies where they believe share their values and their outlooks on the world. And there's a term I came across when I was researching this, and that's called a greenium. So a premium, but a greenium for companies that have strong ESG, environmental, social, and governance initiatives in their organizations. And so they believe that the value ascribed to those companies is greater if they're benefiting society than if they're harming society. So they choose to invest in companies that are doing good and doing well. And the magnitude of that greenium depends on the strength of preference by those investors for each of the factors, whether it's environmental, social, or just better governance. The more they care, the more value they put against it, and the more they value these initiatives. And so we're seeing the sea change now in that we see investors caring about these things, in some cases being very active and vocal as shareholders, sometimes even taking activist positions on boards and advocating for these kinds of changes. And this is important because when you have a higher stock price and valuation because of these initiatives, it lowers the cost of capital to actually invest in these initiatives. So there's a virtuous cycle here, in that if you say, this is something we want to invest in, your stock price goes up, you're able to issue more shares or get capital loans at a lower price, then you can actually invest in these things and it costs less. And so this has a lot of implications in terms of how you think about your initiatives, how you talk about that with your shareholders, how you position it, and also the nature of the initiatives and the reasons why people would want to invest in the organization. So investors can be really happy if they support some of these areas and they're doing well, they're providing capital, it just makes sense. But if you're an investor who doesn't care about these things, then you're not going to care to invest in these companies. You think it's a waste, and they have a lower, and you're going to invest in companies that have lower commitments to stakeholders. So in many ways, it's taking a capitalist approach to thinking about allocation of capital against what people value. So I think one of the things that is so interesting about this, and I think Jay has another great point here. At Davos, a lot of the U.S. attendees, and I see this and going to and talking to a lot of CEOs, that ESG is seen as woke. It's seen as not a serious thing. The reality is investors are taking it very seriously. And so with that change, the CEOs may not want to do this because they believe the investors don't want to invest in it. And there's still a very vocal group of people who do. But there are other investors who care a lot about it. And they're rewarding the companies that are doing this. So I think one of the key questions becomes, it's still complicated though. Because as I said, even with the how do you actually value what an individual investor or group of investors care about? And I'll give you an example. If you just take ESG, environmental, social, and governance, nobody's really strong in all of those. So I'll give you an example. Tesla's really strong in environment. I mean, they created the whole electric car industry, prove that it could be viable. But as you have seen through the turmoils and tribulations of Elon Musk over the past couple of months, years, frankly, they're not great on governance. Tesla is not strong on governance. So the premium they get, is that coming from the belief that they're doing great on environment and will increase their ability to increase their impact on government? Or is it really coming from the weakness of the governance? And you could see the share prices going up and down depending on the ESG, the E and the G parts in particular that Tesla's doing. And then the other part is Apple. Let's take another example. Really strong on social. The strong in terms of protecting people's privacy and its advocacy for addressing the inequality in their working environments, but they're not great on environmental. Again, the products, again, if I have an Apple Mac laptop, I have these phones. If something breaks, you have to toss the whole thing. You can't just repair them. So the right to repair my devices from Apple is really, really low. Basically, I have to chuck it and get a new one in most cases. So there are great examples. It's really complicated. So how companies think about which area they want to focus on, where they think the investor appetite is for this really depends. And most also, you can see this being reflected in the different geographies. The companies in the US versus Europe versus Asia have very different types of investors, different types of regulatory environments, and then also very different types of priorities then put upon by the leaders of these companies there. Europe is much more focused on environmental activities. There are requirements now to report on ESG. So investors there have a very different appetite for that than the US, where there's a very different type of regulatory environment that's happening, which is, again, Jay, to your point, that the US investors and US companies are putting a much lower emphasis on ESG. So, and yeah, Jay, it says that Europe and Asian investors continue to see the value of ESG versus the US counterparts. And Mirza actually has a great point here. Glad you're excited about this topic. What strategies have you seen prove successful in countering the challenge of scarcity regarding digital transformation success? That's a great question, Mirza. Thank you for asking that. And again, people, please ask questions. We'd love to answer them. One of the biggest issues around digital transformation, again, so much of it fails, is that it lacks this overarching view of what it's trying to do. And any sort of transformation, whether it's digital transformation, business transformation, sustainability transformation, is made up of all these different initiatives, and they're not being pulled together under one roof, one vision, one goal, an objective of what we're trying to achieve. So these strategies that I'm talking about today, having that underlying strategy, the first one where I talked about innovation and excellence, for example, really elevates efforts like digital transformation to that higher level. What are we trying to do here? We're trying to increase the sustainability of this business, but not just this business, of the entire ecosystem. So when we start thinking about all of these things together as one big system, it really changes the way you view individual initiatives as, for example, part of digital transformation. So hopefully that gives you a really quick idea, but the people talking about digital transformation from a scarcity point of view are the same. That's the same challenge as what I'm talking about today. If you think about it as limited resources in the short term, how are you going to prioritize that? Well, you're going to prioritize that against what you think is going to generate the greatest value long term. And if your scope of that value is limited to just shareholders and profits versus a larger system of increasing value, not just for profits, but of customers, employees, the environment, the community, it goes on, you start actually increasing the value across the board because you're calling those stakeholders in too as well to help create that value. This is the core of the research that I'm doing right now at PA Consulting. We're looking at how do we create value over the long term? And how do we as leaders need to change our thinking around the ways to create that value, which is why I'm so fascinated by this area. And I think you'll start knowing that it's actually working when you have true examples of value being created. Wage growth, over, especially in the first 5 years of employment, capital expenditures, and how we distribute profits from shareholders to the stakeholders. Here's a great ratio that I found: tracking the ratio of political lobbying expenditures to tax payments. So, how much is a company spending on lobbying? What are the tax payments? Are they trying to game that system versus paying their quote fair share of taxes? And so this comes to my fourth area, which is the role of government. And I'll just take a very, very quick look at this. In that, in the end, there are certain places where there is no stakeholder that can be represented. And I think the environment and our communities, but especially the environment, is a great example of that. The reality is that climate risk is not financially incurred by the producers of emissions of that climate risk, and instead is borne by society. So the idea is, if I'm creating emissions, I don't actually have penalties coming back to me. So I can just freely create emissions and no one's going to come after me because I can just freely do this. And this is what's been happening for hundreds of years. And there is a cost, and the cost is being borne by our communities, by our society, by us individually. And so who's going to put a stop on this? And the role of government has always been, how do we create fair and equitable ways to compete? Which is why governments will come in and take away monopolies to create more competition, limit the ability for this concentration of wealth and power. And for stakeholder capitalism to work, there needs to be some sort of checks, not a lot. I mean, the last thing I want to do is to have a lot of checks on government, because I do love the ability for the flexibility and the creativity that free markets create. But we also know that free markets can have a tendency at times to have these situations that come up that are not ideal for competition, for true value creation to happen in the marketplace. And I think we're at one of those juxtapoints, those critical points, where we're seeing the need for better information, therefore the need for better measurement, as we're seeing in the European Union, coming soon to a local government, the US government as well. So, and we're seeing the need for more climate action. We saw, again, more incentives being put in place for good behavior, and also penalties for really bad polluters, for example. And so these win-wins, I think, need to be engineered in some cases by some better regulators, by better oversight, to make sure that the worst actors are not able to do that, and to create those incentives again for us to create these win-win situations. So that's what I have for today. I just went through a ton of information in a very short amount of time. I'll be posting an article that summarizes this on my LinkedIn newsletter. So I encourage you to go take a look. Just go and find me on LinkedIn, Charlene Lee. On LinkedIn, it's easy to find, and you can subscribe to my newsletter there. But next week, I am going to be talking about a new topic for the month of February, which is about innovation. And next week, I'm going to go and do a deeper dive into some research we released last summer on breakthrough innovation. What is it that drives breakthroughs? And I have spent my entire career looking at disruptions and transformations. And this one, we're doing a deep dive into one very specific area. How is it that organizations drive breakthrough innovation and rise above the sort of the incremental innovation that most of us are pretty good at? But how do you reach that magical place of creating breakthrough, things that really transform the business? So join me next week, Tuesday at 9 o'clock Pacific, 12 o'clock Eastern, and all the various time zones that you're in. And again, I love this topic of stakeholder capitalism. We'll be returning back to it when we release our latest our report in late March. And by all means, please stay in touch. I think we have, one last comment from Jay. Jay, you're very active today. We need fair, in reference to the government actions here. We need fair referees and a fair system, hence government. Without them, you have FIFA. So nice little a little dig at the soccer world. But I think more than anything else, Jay, you're talking to the point is, again, we do need some fairness in the systems. And so that is the role of regulators in particular, less so the politicians, but the regulators, to come up with fair and reasonable regulations. And I think more than anything else, we as leaders need to have a say in that. We can't just leave it to people to hopefully come up with the right thing around this. So, if you have a point of view, please have your raise your voice and make it be known. So I'll leave that at this point. We'll talk about breakthrough innovation next week. Until then, take care. Have a great week.